Welcome to HouseLux Estate, your trusted source for all things finance and investment. Our mission is to simplify complex financial concepts and help you navigate the labyrinth of investment opportunities. Today, we're peeling back the layers on a topic that's often shrouded in mystery and misperception. How do hedge funds make money? It's a question that intrigues many, and by the end of this video, you'll have a clear understanding. So let's dive in and unravel the mystery of hedge funds. To understand how hedge funds make money, we first need to understand what they are. Hedge funds, in their simplest definition, are a type of investment vehicle. These are not your everyday savings accounts or retirement funds. They are a bit more complex, a bit more sophisticated, and, well, a bit more intriguing. Think of a hedge fund as a club where the members are investors and the entry fee is their investment capital. But unlike most clubs, the hedge fund club is exclusive. It's often reserved for high net worth individuals and institutional investors, like pension funds or insurance companies. Now, the person running this exclusive club is the hedge fund manager. This is the maestro, the conductor of the orchestra, the individual who decides where to invest the pooled capital. And this is where hedge funds start to differentiate themselves from other investment options like mutual funds. While mutual funds typically stick to a more conservative script, investing in stocks, bonds, and other traditional assets, hedge funds are more adventurous. They can invest in a wider range of assets, from real estate to commodities to derivatives. They can also use more complex strategies, like short selling, leverage, and arbitrage. In essence, hedge funds aim to generate high returns regardless of market conditions. They're called hedge funds because they aim to hedge or protect against market downturns. But don't be fooled. While they aim to minimize risk, they can also be high-risk, high-reward ventures. So why do investors join this exclusive club? Well, the potential for high returns is certainly alluring, but it's also about diversity. Hedge funds can provide a counterbalance to more traditional investments, potentially reducing overall portfolio risk. But remember, with great potential reward comes great potential risk. And while hedge funds can offer a unique investment opportunity, they're not suitable for everyone. They require substantial investment, a high tolerance for risk, and a long-term investment horizon. Now that we know what hedge funds are, let's see how they make money. Hedge funds make money in a variety of ways, but the most common method is through investment strategies. Now, let's dive into the world of hedge funds and explore some of these strategies. First up is the long-short equity strategy. This is the bread and butter of many hedge funds. The idea here is simple yet effective. The fund manager takes long positions in stocks they believe will increase in value, and short positions in stocks they believe will decrease. This strategy aims to profit from both rising and falling markets, providing a cushion against unpredictable market movements. Next, we have the market neutral strategy. This strategy is all about balance. The fund manager takes equal long and short positions in different stocks with the aim of achieving a zero net market exposure. This means that the overall fund's investment performance is independent of the direction of the market. Instead, the focus is on the relative performance of the chosen stocks. Lastly, let's look at event-driven strategies. These strategies aim to capitalize on price distortions that may occur before or after a corporate event, such as a merger, acquisition, or bankruptcy. Fund managers using this strategy are often experts in corporate law and finance, and they use their expertise to predict how these events will affect stock prices. Each of these strategies involves a high level of expertise and risk management. Hedge fund managers must continually monitor market conditions and adjust their strategies accordingly. They use sophisticated algorithms and quantitative models to predict market trends and make informed investment decisions. Remember, these strategies are not exclusive. Many hedge funds use a combination of strategies, tailored to their specific goals and risk tolerance. It's a dynamic and complex system designed to maximize returns while managing risk. These strategies are just the tip of the iceberg. Let's look at some more ways hedge funds make money. Opening. Another major way hedge funds make money is through fees. Now, when we talk about fees, there are typically two types that hedge funds charge: the management fee and the performance fee. Let's break these down. The management fee is like a retainer. This is a fee that hedge funds charge simply for the privilege of having them manage your money. It's typically a percentage of the total assets under management and is charged regardless of how well the fund performs. The industry standard is often around 2%, though it can vary. Then we have the performance fee. This is where things get interesting. The performance fee is a percentage of the profits earned by the hedge fund. It's an incentive for the fund manager to perform well because the better the fund does, the more the manager earns. The performance fee is typically around 20% of the fund's profits, but again, it can vary. These two fees together form what's known in the industry as the 2 and 20 rule. The 2 refers to the 2% management fee, and the 20 refers to the 20% performance fee. So let's say a hedge fund manages $1 billion. At 2%, the management fee would be $20 million. Then, if the fund earns a 10% return, or $100 million, the performance fee would be $20 million. That's $40 million in fees from one fund in 1 year. But remember, fees aren't just free money for hedge funds. They come with their own risks. High fees can deter potential investors. Plus, if a fund doesn't perform well, investors may pull their money out, reducing the assets under management and hence the management fee. And of course, if the fund doesn't make any profits, there's no performance fee. Closing. Fees can be a significant source of income for hedge funds, but they also come with their own risks. As with any investment, hedge funds come with their own set of risks and rewards. The allure of hedge funds often lies in their potential for high returns. These funds are managed by some of the most brilliant minds in finance, utilizing complex strategies and sophisticated instruments to generate profits. It's not uncommon to hear stories of hedge funds delivering double or even triple-digit returns in a single year. For the savvy investor, the prospect of such profits can be incredibly enticing. But it's critical to remember that hedge funds also carry a significant degree of risk. The very strategies that can result in remarkable profits can also lead to substantial losses. When a hedge fund bets big and loses, it's the investors who bear the brunt of the blow. We've seen cases where hedge funds have collapsed overnight, wiping out billions of dollars in investments. Moreover, hedge funds are notoriously opaque entities. They are not required to disclose their investment strategies or positions, which can make it difficult for investors to fully understand what they're getting into. This lack of transparency can exacerbate the risks associated with hedge fund investments. It's also important to note that hedge funds are typically only available to accredited investors. These are individuals or institutions that meet certain financial criteria set by regulatory authorities. The logic behind this is simple. Accredited investors are presumed to have the financial savvy and resources to weather the potential losses associated with hedge fund investments. And let's not forget the high fees associated with hedge funds. The typical 2 and 20 fee structure where managers charge a 2% management fee and a 20% performance fee can eat into your return significantly. In conclusion, while the potential rewards of investing in hedge funds can be high, the risks are equally substantial. It's a game of high-stakes poker, where the potential for reward is matched by the risk of significant loss. So, hedge funds can be a lucrative investment, but they're not without their challenges. So, there you have it. That's how hedge funds make money. Let's take a moment to recap the important points we've unraveled today. We started off by understanding what hedge funds are in essence. Private investment partnerships that employ complex strategies to generate high returns. They are the daredevils of the financial world, taking calculated risks to reap substantial rewards. We then ventured into the fascinating realm of how these hedge funds generate income. There are two primary sources. First, the performance fee, which is a percentage cut from the profits they make for their investors. This incentivizes them to strive for optimal performance. Second, the management fee, which is a fixed percentage of the total assets under management. This ensures a steady income for the fund, irrespective of its performance. We also touched on the intriguing investment strategies employed by hedge funds. From long-short strategies to global macro, event-driven, and relative value strategies, these funds use a mix of methods to maximize returns. But as with any investment, hedge funds bring their own set of risks and rewards. They can offer high returns, but they can also lead to significant losses. It's crucial to be aware of these risks and to understand the volatility and potential for loss that comes with such high-stakes investing. Thank you for watching House Lux Estate. Don't forget to subscribe for more informative videos on finance and investment. Until next time, keep investing wisely.